Okay, we might as well jump right back in. I want to thank everybody for coming out this afternoon. I know for a lot of us here in the room, it's been a rough couple of days. Speaking for myself, it's been a rough couple of months, to be honest. Even the S&P has not been friendly to us at all. And ironically, this class is coming at an opportune time. I can guarantee that margin calls are a big issue in many traders' lives at this point, even those that were trading in a way that they thought was conservative. For example, deep out of the money options or spreads, things like that. With this type of volatility, margin can sneak up on you and sometimes take you by surprise. So we're going to talk about a few ways to minimize or mitigate margin without actually liquidating positions and adding money. I mean, to be honest, that with what's going on the last couple days, some of these things may or may not be quite as effective. For example, I know some traders and option traders that received a margin call on yesterday's close, but the futures markets moved so far, so fast that by the middle of the night last night, their margin call had gone from one number to something completely different. In fact, they were, as you know, in futures trading, you can lose more than you have on deposit. And so that was an issue for a lot of traders last night. So not only became a margin call, but it became a negative account issue. And so that's no fun either. It's been a very humbling couple of months, I'll put it that way. But that's what markets do. They're always changing and we're always learning. And, all we can do is pick ourselves up again, dust ourselves off, and move ahead. So if you're not familiar with me or who I am, my name is Carley Garner. I am a commodity futures and options brokerage service in Las Vegas, Nevada. I shouldn't say I am the service, but I run one in Las Vegas. Here's my contact information. If you have any questions or anything, concerns, comments, feel free to give me a call or send me an email. You'll find me on social media if you're interested in following on Facebook, Twitter. We post a lot of trading charts, market commentary, that sort of thing. Also a lot of pictures of my dogs. So if you like dogs, follow me on Instagram. So as I mentioned, I am a broker, a commodity broker. I'm a strategist and an author. I also write a monthly column for Stocks and Commodities magazine. You may have also heard my name or seen me on the show Mad Money. Jim Cramer uses our commodity analysis a lot, mostly crude oil, gold, treasuries, that sort of thing. But every once in a while we'll go on for currencies and stock indices, things like that. If you're interested in anything that we talk about today, if you want to learn a little more, get a little more in-depth information, you will find a lot of that in Higher Probability Commodity Trading. That book is something that basically is the culmination of everything I've ever learned, both good and bad, good lessons, bad lessons, throughout my career. So Higher Probability Commodity Trading will provide information, whether you're trading futures or options or both. It'll give you a really good perspective on market analysis, coming up with strategy that fits your personality, that sort of thing. And if you're a little more of a beginner and you're not really familiar with futures and options on futures, A Trader's First Book on Commodities is a good place to start. It starts from ground zero. It's everything you need to know before you actually place a trade. Both of those books are available on Amazon. That's the cheapest, but you can also get them in any bookstore or online outlet. So before we really get into things, I want to make sure that we all understand there is substantial risk of loss in trading futures and options. Trading is not suitable for everyone, particularly in the environment that we're in, where we're seeing the S&P move 100 to 200 points in a session. Risk is big. We're not, it's not an investment in which we collect dividends and interest coupon payments. This is speculation, and sometimes it can be great and sometimes it can be devastating. That's part of the game, unfortunately. The nice thing about futures and options is it's the trader himself or herself that chooses how much leverage you want to use, how much risk you want to take. It's extremely customizable, I guess I should say. So, and we're going to kind of show, as we go through this class, we'll actually talk a little bit about that. The exchanges offer you a heck of a lot of free leverage, but you don't have to use the leverage. In fact, you probably shouldn't. For example, you can buy or sell crude oil for $3,000 to $4,000 in margin, and you're trading $50,000, $60,000 worth of crude oil, depending on what the price is at that time. As you can imagine, it wouldn't be very hard to lose a lot of money on a $50,000 crude oil contract with $3,000 in your account. There's just not enough room for error, margins too tight, that sort of thing. So let's start with the basics. What is margin? Now keep in mind, futures exchanges guarantee every transaction that takes place. This seems like a given, but it really isn't. When you trade something like Forex or other over-the-counter marketplaces, there's often, sometimes not somebody guaranteeing the position. So what I mean by that is, if you were trading Forex a couple of years ago when the Swiss franc took a massive rally in the overnight session, if you were long the franc, someone else had to be short the franc, one of the brokerage's other clients or whoever took the other side of the trade. If the person on the other side of the trade couldn't pony up and pay for his losses, you as a winner of that position may not ever see that money. That seems kind of crazy to us in the futures world because we know that everything on the CME is guaranteed. And the way they can guarantee that is margin requirements. A margin requirement is basically a good faith deposit. It's a line of credit for every trader that ensures that they have the amount of money necessary to cover any losses that they might sustain. Margins are set in a way that they try to, futures margins anyway, options margins are probably a little low in reality, but futures margins are set in a way that they want to make sure that the trader has enough money in the account to cover what would be considered a maximum daily loss. Now we all know there is no such thing as a maximum daily loss. It's highly possible that somebody could lose more than what the initial margin requirement is in a single day. But that's kind of the rule of thumb that the exchange goes off of. So if the exchange wasn't guaranteeing every position and they weren't requiring margin, can you imagine the amount of illiquidity and market inefficiency we would see? It would be nuts. Luckily, we have orderly markets, even in a day like today or a day like yesterday where the markets are all over the place. Believe it or not, it is actually relatively orderly. As an option trader, if you were looking at the E-mini S&P options last night, they became insanely expensive. Like, it was wild how expensive the options got. Nonetheless, there were almost always somebody there to take the other side of the trade. The bid-ask spreads were relatively tight, so it wasn't a matter of the spreads blowing out. It was just a matter of the options getting way overpriced, and that's probably because there's a lot of short option traders out there that have made a lot of money selling puts in the S&P for years, and so when the market cracked, all of those people were forced to buy their puts back to meet margin calls and that sort of thing. And generally, they're getting out because they have to, not because they want to. So what do? They pay the ask. And when you pay the ask price, it blows up the options. Well, if one individual person pays the ask, that's not going to blow up the options. But when you have trader after trader after trader paying the ask, paying whatever the market maker will throw out there as a quote to get out, that's when you see the option market explode. And it's almost like the option market's broken until everyone that needs to get out can get out. And unfortunately for those people, they are often getting out at very poor pricing. But that's if we all had a crystal ball, we would know how to handle those situations better, but unfortunately we don't. Sometimes poor pricing can become even more poor pricing. It can get worse. So specifically, margin is a specified amount of funds stipulated by the exchange and required to be held in a brokerage account to hold positions. It's a good faith deposit ensuring that each trader has the ability to meet their obligations and that others will also be able to meet their obligations, enabling a correct trader to profit from correct speculation. Because the exchange requires a small amount of margin for a very large futures contract, and keep in mind each market's a little different in regards to how much leverage is there, but again, we'll go to the crude oil example one more time. I think the margin's actually gone up a little bit since then, but we'll just say the margin's roughly $2,500, and you're controlling $64,000 worth of crude oil. If you're familiar with crude oil, each dollar change in crude oil price equates to 1,000 profit or loss for a trader. So this particular trader can be wrong by $2,000, I'm sorry, by $2 in crude oil, and that would blow out their whole account. So you can see there's not a lot of room for error. If you're having a hard time grasping the idea of leverage, just think about when you purchase a house and you put down 20% or 10% or whatever it is that you put down on that house. The amount of money that you put down as your down payment is going to make or lose money based on the entire value of the house. So if you buy a $200,000 house and you put $20,000 down, if the house goes to $220,000, your equity has gone from $20,000 to $40,000. So that's leverage. So there's two types of margin. There is initial and then there's maintenance. I really advise traders to focus solely on initial. I think maintenance is, I mean, it's nice because it gives you a little extra buffer between a margin call, but the reality is you should really try to keep your account within initial, and in fact, you should probably try to keep your account well within initial, depending on your strategy. If you're an option seller, you probably don't want to use more than 20 to 40% of your account towards margin. Some of you might think that's crazy to keep 70, 80, 60%, whatever it is, of money just sitting there doing nothing, not earning anything. But the reality is, as an option trader, sometimes it's, well, I should say all the time, it's more important to survive the unforeseen events and the spikes in volatility than it is to be greedy and squeeze out every last dime of profit potential along the way. Because trust me when I say an aggressive option seller can do really, really well for a year, maybe 2 years, but then it takes one day to ruin all of that. And even a conservative option seller might experience this from time to time when the markets experience massive movements, such as what we're seeing in the S&P. So the bottom line is initial margin is the amount of money that you need to have in your account to put a trade on. The maintenance margin is what you need to have in the account to avoid a margin call. The maintenance margin is generally about 10% below initial margin. So as long as you keep your account above, your account value above the initial margin, there's no margin call. It's possible for your account to dip below the initial margin, but yet be above maintenance margin and not trigger a call. So you may see, like at the bottom of your statement, you'll notice almost all commodity account statements have margin excess and deficit figures. So it's possible you could have a margin deficit and not have a margin call, and that's because your deficit isn't big enough to bring your account below the maintenance margin. But again, you want to focus on the initial margin, focus on keeping your account well within that. So a lot of people ask, what exactly is a margin call? Is my broker going to call me? Well, it depends on where you're trading and who you're working with. If you're working with a full service broker or with an online brokerage service that has enhanced service levels, so in other words, not a deep discount brokerage that gives you a platform and never talks to you or answers your emails, not that kind of brokerage, but one that'll give you a little bit of service and hand-holding. That type of brokerage will generally shoot you an email or a text message or give you a call, whatever your normal method of communication is, and notify you of that margin call. But you're also going to see it at the bottom of your account statement. So always keep an eye on your daily statements. I know a lot of people in today's world, they want to focus on their trading platform. But the reality is the trading platform it's nice because it's going to give you real-time information, but the reality is the exchange, when it comes to margin calls and margin levying, they only levy margin at one time of day, and that's really all that matters. And all that matters to them is where the official closing prices are and that sort of thing. So it's a little bit weird, but that's how things work. So always keep an eye on your statement. Make sure you're within margin parameters, that sort of thing. So in other words, in short, to summarize, a margin call might not include an actual phone call. If you're a self-directed trader, you're really responsible for margining or for monitoring your own account. So a call or an email would be a courtesy. If you're at a discount brokerage firm, there's a high chance that if you trigger a margin call, somebody's going to go in and liquidate your trade without even saying anything to you, without asking you, without giving you a chance to nullify, to fix the situation. For full disclosure, my brokerage service, we don't do that. We will not liquidate on a margin call. We won't touch your trades. The only times we would ever step in and touch your trade is if your account is in danger of going negative. And even then, sometimes the markets move so far, so fast against a client's position that it's impossible to stop it before it gets into the green. So into the red. So remember, as a commodity trader, whether you're trading futures or short options, you can lose more than you have in your trading account. So it's, it can be a little bit scary for traders and brokers, so just keep that in mind. If you're a long option trader, then you don't have to worry about that because your risk is limited. Okay, and so if, along with initial and maintenance margin, there's also two things to remember about initial margin. There's day trading margin and overnight margin. The overnight margin is basically initial margin. That's the amount of money you have to put a position on and to hold it through the close of trade. Now, people get confused because the close of trade, when is it? The markets are basically always open. Well, for most futures markets, the close of trade is 4 p.m. Central Time, and then it actually also reopens at 5 p.m. Central Time. So it's really only closed for an hour. So the exchange only measures margin at that 4 o'clock close. Anything you do from the 5 o'clock open, around the clock, to the 4 o'clock close really applies day trading margins as long as you're in and out within that session. Now again, it depends on the brokerage you're using. Not all brokers treat the entire session as a day trade. Sometimes they will only let you use day trading margins during the official day session of that particular market. So just be aware of who you're using and what who you're working with. Our clients do get day trading margins around the clock. Stock indices are actually deep day trading margin rates during the day session, but also, more reasonable day trading margins in the overnight session. So just be aware of how your broker operates. So you may have realized that if you want to hold a position, but you don't have the margin to hold overnight, you might consider just selling on the close and then opening it back up when the market opens an hour later. Generally, the market hasn't moved much from that area. Now, obviously, it's a little risky because you're basically trading with money you probably don't have and you're over leveraged and that sort of thing, but it is something to keep in mind. If you're on a margin call and you need to buy yourself a little time, that might be a way to do it. So just as a disclosure, you will notice that some discount brokerage firms offer $300, $400 margin requirements on E-minis. That's generally a very, very bad idea to trade with that much leverage. Our brokerage, depending on platform, we do offer day trading margin in the stock indices as low as 500, but I really highly suggest that you don't use that much leverage. I think you're better off, even as a day trader, you may want to really only use maybe one lot per 10,000 or so. Of course, it's a personal choice, but generally in this business, less is more. And another thing to keep in mind is, this is totally off topic, we'll be doing a class next month on this. The CME now lists the CME now lists weekly options, and they actually have Monday and Wednesday options. So there's options on the E-mini S&P expiring 3 days out of the 5-day trading week. And that is awesome because what it does is it allows day traders to use options instead of futures. And we've had classes in the past where we talk about buying or selling an E-mini futures contract and then hedging it with an option. But with these options that are available every other day, well, actually they're available every day, but they expire every other day. So they are, because they have a short time to expiration, they're generally cheap, although at this particular moment in time, they're not cheap because of the volatility. But in a more normal market circumstances, you could, if you think the S&P is going up 10 or 15 handles today, or maybe even today and possibly in the overnight session, you could just buy a really cheap call that expires tomorrow. That way you don't have to worry about getting stopped out. Your risk is limited, so there's definitely some advantages to that. And you don't have to worry about margin. You could hold the long option overnight and not have any margin requirement at all. So it's kind of like day trading and swing trading, but without the margin. Of course, there's, it's not a perfect world. You have to pay premium to do it, but the premium is usually relatively reasonable because there's so little time to expiration. So anyway, if a margin call does trigger, don't panic. Unfortunately, it's part of the game. I know it's scary and it's no fun. And from a mental standpoint, it's exhausting. But it happens. So here's kind of what you can expect if it does happen to you. A lot of people want to know, how much time do I have? If a margin call is triggered, how much time am I going to have to bring the account into compliance? Now, it depends on the broker you're using, and you really need to be aware of this before a margin call triggers. Even if you're someone that believes you're probably never going to trigger a margin call, still a good idea to be aware of how your broker treats it, so that if and when that day does come, you know how to react to it and you can be proactive. Some brokerage firms will only give you 1 day, and as I mentioned before, some discount firms won't give you any days. If a margin call triggers, they jump in and liquidate and they don't ask any questions. Some brokerage firms will give you up to 3 days, but really, to avoid hassles and fees, and you don't want to have a bad reputation with the risk department, it's really advisable to try to take care of all margin calls on day 1 if possible. I know sometimes it's not possible. Sometimes the markets are just really wild, and you think you moved enough to take care of it, and then find out on day 2 you're still on a margin call. So try to be within margin by day 1. If you're not, it's usually not the end of the world if you're dealing with a reasonable brokerage. But by the 3rd day, you really should buckle down and make sure you absolutely have everything under control. You really want to try not to go to the 3rd day because it takes a lot of your options away. On day 1 and day 2, you're probably free to adjust your positions, try to shuffle some things around, and we'll show you some ideas on how to do that. But on day 3, honestly, it's just, at this point, you have to just liquidate. You need to get out. You need to make sure that you're in compliance. So as a general rule of thumb, this is kind of how it works. Day 1, it's basically a friendly warning that you're trading a little beyond your means. It's a freebie. Most firms won't charge margin call fees on day 1. Most firms won't force liquidate, but you really should never add to a margin call. If you have a margin call, do not put fresh positions and fresh risk off on. That is a little disrespectful to your brokerage's risk management department, and they're not going to be happy with you. You don't want to get on their bad side, trust me, because when the time comes that you need a little favor, it's going to be nice to have them on your side. So a lot of brokerage firms do charge margin call fees on day 2. With some of our clearing arrangements, our clients are subject to that. With others, they're not. So again, make sure you understand how your account is set up and what is applicable. But again, you really want to try not to get to a day 2. Not only is the fee annoying, but if you're on day 2 and you haven't taken action, you're probably letting things get out of hand. And I know, at least one trader I know used to always say, the thing about margin calls is never meet them, because usually if you're on a margin call, you're wrong and your position's not going to improve. I'm not sure I always believe that, but there's definitely some logic to it. So if you do go to a day 3, you can probably expect at some point, if you're just refusing to take action, the risk managers will jump in and start liquidating your trade. And trust me, this is not what you want to happen. Risk managers could care less about price or timing. They're not looking to save you the bid-ask spread. They're going to try to buy everything back at the market price, and that's it. So don't let them be in control. You want to be in control of your own destiny. Okay, so let's talk about adjusting risk, delta, and margin requirements without adding funds or doing that sort of thing. So the first thing we need to know is delta. Delta is the percentage change of a price of a position relative to the change in price of an underlying futures contract. So what this means is delta has a futures, the delta of a futures contract is 1. That's because as every point that the futures market goes up, you're making a point, and if the futures price goes down, you're losing a point. That makes sense, right? An option delta is going to be anywhere from 1 to 0, usually somewhere around usually between 30 and 60 is kind of generally where they hover. You can lower the delta of your overall position by trading options around it. The lower position delta, the lower risk, the lower margin. So what I mean by delta, again, just to make sure you understand, is if the delta of our trade is 0.5 or 50%, for every point that the futures market moves, our position is only moving a half a point. So it's just slowing things down. It's taking a futures contract with a delta of 1 and cutting that in half to something that moves slower. So you can kind of think of it as converting an E-mini S&P to maybe an E-micro S&P or something like that. You're taking some of the leverage away. So there's a few things that you could do to lower your delta. And the thing about option trading that's so great is you can just be creative. You can always, depending on the situation, there's always an appropriate strategy, and sometimes it might mean buying a put against your futures. Sometimes it might mean selling a call. But let's talk about some of those. So if you're a trader and you're long a futures contract, you could buy a put option. A put option basically acts as an insurance policy. It limits the risk. Absolutely. So if you're long a future and you buy a put and the price of that futures contract drops to 0, your risk is limited because the put is protecting you. It's your insurance policy. It also decreases the delta of your position depending on what the delta of your put is. So for example, let's say that we buy a put option with a delta of 30. Your new delta of the position is going to be 70, meaning you're trading 7/10 of a contract, essentially is how it works out. You could also, instead of buying a put, you could sell a call. Selling a call does not limit the risk, but what it does is it takes some of the edge off of your position because you're collecting premium, you're adding cash to the account, and that cash can be used towards margin. But selling a call also decreases your delta. So if the delta of the call is 0.3 and you're long a futures and then you sell a call with a 0.3 delta, now you're net long 7/10 of a contract. So we got our delta to 7/10 of a contract, 2 different methods. Or you could even do both. You could go along a future, you could buy a put under the market, and then you could sell a call out of the money to pay for that put. That's called a collar. I'm having a brain freeze here. That's called a market collar. The thing to be careful with on collars is you want to spread out your strike prices, otherwise it's impossible to make any money. Some people try to put collars on using at-the-money options, and they basically are just locked into a box that can't make or lose money, which the thought of not losing money, I guess, is okay. But if you have no potential to make it, it doesn't make any sense. So be careful with that. But the point is here, you want to get creative and you want to keep your mind open to what the possibilities might be. So before we were talking about a trader that was long a future, let's talk about a trader that's short a future. If you're short a future and you want to reduce your risk and or margin, you can buy a call option. And again, the call option acts as an insurance policy. It limits the risk above the market, absolutely. And it also decreases the delta of the trade. Or you could sell a put If you're short a future and you sell a put against it, your risk is still unlimited. If the market shoots up, you're still going to get into trouble on the upside. However, the premium that you collected for that put gives you a nice risk buffer. And this is a strategy that we've used, that we recommend quite often, especially in commodities, for example, when commodities are at a deep, deep discount and we want to go long a futures contract, but we're a little hesitant to go long naked. We want to put a hedge on. So we can sell a call option against that, bring some premium in to make sure that we have enough of a risk buffer to cushion our emotions and losses and things if the market sells off a little before it moves higher. So selling an option against a futures contract doesn't limit your risk, but it greatly improves your odds of success. And again, you don't have to just do one or the other. You could do both. You could sell a futures contract, buy a call, and then sell a put. And I know this is kind of hard to imagine while we're just staring at some words on the screen. So let me show you what it might look like on a chart in a real life situation. So this is a trader that is short the NASDAQ, but in a runaway market. We all know through the month of January the stock market was on a complete tear, and we all know how that ended. But for a while anyway, somebody that was short the NASDAQ might have been nervous about the upside, might have had margin issues, and might have wanted to control their margin and risk. So let's assume a trader short from 68.50. Right here. So two things they could do. They could buy a weekly 69.20 call expiring in 1 week. And again, I mentioned previously the weekly options. They are extremely handy because they're cheap. There's not a lot of timed expiration. So if you're looking to swing trade, let's say you want to be in a position for a day to 3 days to 5 days, you can use the weekly options as your insurance policies, and they're cheap. And so it gives you a nice, affordable trade, low risk, and pretty good, some good protection there. So anyway, this trader might have purchased the 69.20 call expiring in 1 week for 25 points or $500. That trader is short from 68.50. So there's a gap between where he's going short and where his protection kicks in. So there is a little bit of risk there. The margin on a going short the NASDAQ naked without buying the call option is 52.25. Okay, so once we buy the call option, oops, I did it backwards. Let's start with put. I'm sorry, that was confusing. So we're selling at 68.50, and then before we buy the call option, we're going to sell the put as a hedge. So we can sell a put that expires in 50 days. Now, as a seller, remember, you want to bring in a lot of premium as a seller. As a buyer, you don't want to pay very much. I mean, it's just like everything else in life, right? You want to buy things that are cheap and sell things that are expensive, so that's not a surprise. So as a seller of an option, you probably don't want to use the weekly options unless volatility is off the charts and the options are overpriced, kind of like it is now. But in normal market conditions, you probably want to go out a couple of months to sell your hedge. So this trader could have sold a NASDAQ at 68.50, then sold a 68 put for 2,400 bucks. This has a delta of 0.4. So right off the bat, the trader reduced his delta to 0.6. And by doing that, he reduced his margin to 42.31. Some of you might ask, well, that's not that big of a margin credit, right? It's only like roughly $100, and that's true. But in addition to having $100 lower of a margin requirement, this trader has also collected 120 points in premium, so he can be wrong by 120 points. If the NASDAQ rallies another 120 points, he basically breaks even, assuming he's still holding the trade at expiration. Now, the one downside of this sort of thing is when you sell a put, you are capping your profit potential. So if the market crashes, like we know actually it eventually did, the most this trader's ever going to make is what he collected for the option plus the difference between the option strike price and the futures entry. So profit potential is capped at about $3,400, but that's not too bad, right? I think we'd all take that, especially, I don't know about you, but stock indices, like I had mentioned earlier in the class, haven't really been too friendly to us. They ripped the bulls apart in January and then tore the bears apart in February. So not a lot of winners here as far as I can see. Anyway, this trader, knowing that being short the futures contract and then also short a put, he knows he has unlimited risk. So one way to curb that risk would be to purchase a call option, such as the weekly 69.20. I mean, again, that's only going to ensure the trade for about a week, but a lot of times in swing trading, that's really all you want, right? You're usually not looking for a month or 2 months. You're looking for the next several days. Once you buy that weekly option, the margin drops to $1,100. So you took a trade that was a $5,200 trade in regards to margin and turned it into a $1,100 trade. In the meantime, your delta has dropped to 0.3 or 30%. So it's basically like being short 3/10 of a contract, roughly. That's how the position is going to move in time. In other words, as the NASDAQ goes up 10 points, your position's only going to lose 3 points, or if it goes down 10 points, your position's going to make 3 points. So that's kind of how that works. Obviously, if the market sells off, you're going to be a little sad that you hedged so well. But if the market goes up, you're going to be really, really glad that you did. So in conclusion, margin calls will happen even if you trade responsibly. Don't let emotional turmoil of the event get to you. Don't take your brokerage firm's request to bring the account within margin lightly. You really don't want the margin department stepping in and exiting your trades for you. That is the worst thing that could happen because, like I said, they're not going to go in with a scalpel. They're going to go in with a hacksaw. It might not be pretty. They're not going to worry about nickeling and diming the market whatsoever. Does anyone have any questions or anything about some other ideas on how you might do this? Now, I want to also just kind of keep in mind, you can do this similar kind of thing to reduce the margin on option trades. So for example, if you're an option seller and you run into some margin trouble, you could always consider buying the weekly options as a Band-Aid. But a word of caution, that sort of thing works really, really great if you're right and the market finally rolls around your way. But if you're wrong or just extremely early to the point where you're basically wrong, that sort of thing just kind of prolongs the agony and actually makes it worse. So if you're going to meet a margin call with an adjustment by buying weekly options to hedge or by adjusting something, it can work, and it does in the short run, but it's not going to solve your problem. If your position is wrong and the market continues to go against you, it's going to slowly eat away at you, and it's going to become, at some point, it might become unmanageable, especially in a runaway market. So just be careful with that. Another thing that we don't really talk about in these slides or in this class, but I wanted to throw out there, is if you're an option trader, you can always roll. So if you sell options and you're, for example, you've got, I don't know, March S&P puts that are hugely underwater because of the volatility, you can always buy those back and maybe replace them with June puts deeper down. In most market, and when I say deeper down, I'm saying, let's say, for example, you're short 2,600 puts in March, you could buy those back and sell maybe June 2,000 puts. The odds of the market getting to 2,000 by June probably aren't that great. But just keep in mind, in normal market conditions, that's going to work just fine. In fact, it works like a charm. But when you get markets that are running away, trend markets that just, for whatever reason, no matter what happens, good news, bad news, they're going the same direction, rolling out those in that type of a manner can make the problem worse. So you really, if you're going to adjust your positions before, rather than liquidating or lightening up or adding money, whatever the situation is, make sure you really, really still feel good about the trade so that it doesn't come back to haunt you. So I talk a lot about margin call management and that sort of thing and higher probability commodity trading. Also, putting together a strategy that fits your needs. It might be covered calls, it might be credit spreads, that sort of things. Now keep in mind, not all strategies work in all market conditions. In fact, in that book, for full disclosure, we talk about how in the long run, trend trading really kind of struggles at times. Like there's Obviously, this year, trend traders have knocked it out of the park. Anyone that was long the S&P well beyond what, you know, rationality said it might have been, did very, very well. And then if they flipped it and rode the downside, few people thought the S&P would drop so far so fast. So trend traders might have caught a big chunk of that. So trend trading is done very, very well. But in normal markets, it's the opposite. Trend trading struggles a little bit. Swing trading does a lot better. There's definitely the markets are definitely changing a little bit, and I think we'll probably change our approach just a little going forward, because we have experienced some hardships in markets that are one directional and relentless, I guess is the only word to describe it. I think a lot of it has to do with algo trading, just really pushing the limits, and a lot of the computerized trading and a lot of packaged products being available to retail traders, like the inverse VIX and the inverse ETFs and that sort of thing. I think it's really, it's changed the dynamic a little bit, and so I think it's necessary to kind of try to change along with it. So it'll be an interesting process how we see what the S&P does as we pull out of this and go move forward. So I appreciate everybody coming. If you have any questions or anything, please let me know. I'd love to hear from you. Again, Instagram if you like dogs. If you don't like dogs, Twitter's probably better. But you can email me as well. Garner at DeCarley Trading. Hope to hear from you soon. Does anyone have any questions? You can type them into the chat room if you do. Okay, we're all set. I wish everybody luck. If you need any help, let us know. Yeah, somebody is asking if this class is going to be recorded. Yes, it was recorded, and we will be emailing out to everybody that registered in the next couple of days. We're a little behind, to be honest, with brokered stuff. So as soon as we get that cleaned up, we'll get the video prepped and out. So give us a couple days. Somebody's asking if we do classes on a regular basis. Generally, we try to do classes about once a month. You can find, if you go to our website, go to DeCarleyTrading.com, then go to Learn, and then go to Trading Videos. There's about 30, 35 videos on there of past classes that we've done. So that'll keep you busy for a little while if you're interested in learning more. And it's free. Okay, thanks again, everybody.